Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with a returning guest, Victor Haghani. How you doing today, Victor?
Excellent. Thanks very much.
Great. Well, some of you have been listening to the show for a while. Probably remember Victor. It was a great interview. I think it was 2 years ago, and we brought him back because he has a new book out, and there's some great topics we wanted to talk to him about. So, for those who are not familiar with Victor, Victor, tell us a little bit about your background.
Sure. Let's see. Well, going way back, I've lived in a bunch of different places. I started life in New York. Lived in Iran for a little while. My dad was Iranian. Uh, Lived in London. Went to university there. Came back to the States. Worked for Solomon Brothers. Then went back to London for a long time, for over 25 years, where I had my kids. I was a founding partner of LTCM, the hedge fund, and since 2001, I had about a 10-year sabbatical, and then about a dozen years ago, I started a wealth advisory, financial advisory practice that kind of grew out of what I was doing for myself and my family, kind of a family office turned into a wealth advisor, and it's called Elm Wealth, and that's what I've been doing for the last dozen or so years.
Nice, nice. So, for those of you who don't remember, long-term capital management was a famous episode. I don't know if you want to maybe talk a little bit about that, Victor, just so people understand and kind of like what happened and kind of at least from your experience.
Sure. It's actually the roughly the 25th anniversary of LTCM, and as they say, time heals all wounds. I feel pretty comfortable talking about it 2.5 decades later. There's been a lot of water under the bridge and all kinds of other things since then. Um, there's been a couple of books written about LTCM. I think those books were good books, but they were written too soon after the events. I think it's that I think a little bit more time and perspective would have been good to really think about all the different lessons and things to take away from the experience. And the books, when they came out, they sort of really just tried to give a blow by blow of what happened. So I won't go into that. I will say that in this new book that we have out, I with my co-author James White, we have a chapter that's kind of devoted to LTCM, and I think that one of the interesting aspects of the LTCM story that didn't get much discussion was had to do with the partners with and in particular I talk about my own personal financial decisions there as a business owner, somebody who wanted to have skin in the game. And this is something that a lot of entrepreneurs and all kinds of different people face, investing in their own business. Sometimes it's involuntary. If you work at some company, they might require you to take some of your compensation in company stock. But for a lot of us, it's a choice how much we invest in our own business. And looking back on my experience, I think that of course, if I knew that that LTCM would suffer all those losses, naturally I would have had less invested. But I think what's interesting is that I think that with a more with a more flexible, coherent framework for thinking about sizing attractive investments, I would have had less. I think I would have had less invested in the fund, and that might have led to some other things too. I mean, I know nobody really cares about how much money I personally lost, but I think there's some good lessons there, and I think that in terms of the broader impact of those decisions, that at the end of 1997, LTCM dividended out a lot of profits that our investors had from the 4 or 5 years that we had been in 4 years we've been in operation, and we dividended them out these earnings, or these retained profits, if you will, and that turned out it left us more vulnerable to the events that transpired in late 1998. And perhaps with a different kind of risk framework, looking back on it now, maybe there was a different path that we should have taken. It was debated, and there were some of the partners that that felt that we should have gone that other way. And maybe, thinking about it now, I think that there were some good reasons away from, just the 2020 hindsight, where somebody's sitting there ex ante, might have made a different decision.
Yeah, and I think that's a good start for a segue into the other topic with your book is, as a business owner, making decisions of allocation in terms of what's best for you, both long term and short term. Obviously, everyone who's a business owner thinks their business is awesome and it's going to go through the roof. But how should people be thinking about that, right? I mean, it's what should be the thought process that goes into allocation of or your own personal capital into the business?
Well, I think the first thing is is that we have to have an objective function that makes sense, right? And so, some kind of payoff function that's translating our wealth into, our the utility that we're getting from the wealth. What we're, the happiness or the satisfaction that our wealth is bringing us as we are able to spend it or give it to others. That is going to be a concave function, right? That the more money we have, the more money we consume, the less is each additional unit giving us greater satisfaction. And so that makes us naturally risk averse. And so the first thing is we have to be risk averse with regard to the decision. So we, that we really can believe in our own business and think that it's a great business and that we're going to make a lot of money. But we really need to be maximizing our risk-adjusted return and not just the expected return or our expected wealth. And the other thing that's really important I guess there's a number of things that are really important, but for most people, what also is really important is when you're thinking about these decisions is this intersection of your human capital with your financial capital, and it might be also that your business has a lot of sort of unrealized value. Like in the case of LTCM, I was, all of the partners also owned the management company that was managing the hedge fund, and we earned fees on this management process, and that represented a lot of value to me. So not only did I have my financial capital invested in the fund, not only was my human capital really tied to the performance of this endeavor, but also there was this big sort of unrealized illiquid asset that was my ownership in this management company that I thought was worth a lot of money and that was really delicate and exposed to losses. So I think that really making sure that you're taking an account of all of those different values on your balance sheet when you're thinking about it is really important. And so yeah.
Okay, good. Yeah, no, I think it, you see examples of this in on Wall Street in various capacities. You look at Bear Stearns, right? That a lot of people at Bear had most of their wealth tied up in their stock until after, and then they weren't bankrupt, but they certainly had most of their wealth tied up. And I think it's a challenge. Like, where do you draw the line? But segueing to your book, because I think your book addresses a really interesting topic, which is different, but along the same veins, is your book Missing Billionaires. Tell us a little bit about the background of the book and why you decide to write it, and a little bit of the premise of what it's addressing.
Okay, sure. Well, the reason that we decided to write it is that we realized, and a lot of people realize this, that investing can be thought of as two activities. One of them is you decide what you want to buy or go short, depending on your constraints, but you decide what's attractive to put your money into, and then you have to decide how much of it you want. And when we celebrate the capital asset pricing model, that all these great academics worked on, in the 50s, I guess in the 50s into the early 60s, it's really interesting when you think about that model for your listeners that are sort of, comfortable with how they might have seen it presented to them, either, at school or in books or whatever, that the great celebration of the CAPM is about what people should invest in, that we should all own the market portfolio. And then there's this capital asset pricing line. And as a little bit as an afterthought, then it said, well, and then every investor has to decide where on this straight capital asset pricing line they want to be. If they want to have 100% in this market portfolio of equities, that's the tangent point. If they want to have less, then it's a blend of that with the risk-free asset, to the down to the left and down, or up to the right. It would mean that you want to have a leveraged position in the market portfolio. But it never really talks that much about, okay, so now how do we decide where on that line we want to be? I mean, of course, it was discussed, but I'm just saying when we celebrate and think about the great insight of it, it was this answer, or this idea and insight that, the market portfolio makes a lot of sense for a lot of investors, and not insights about where to be on the line. Well, our book is kind of where to be on that line, more generally. I mean, we're not necessarily saying that you should own the market portfolio, or we're not saying that CAPM is the right model for thinking about the world. We're not saying that at all, but we're saying that making sizing decisions about risk is terrifically important, and it's actually, in some ways, it's more critical. I mean, you can find good investments, but if you get the sizing of it wrong, you can go bankrupt. And LTCM, I think, is a great example of a collection of investments that had a good positive expected return, but the sizing in the fund was too large, and so we didn't get, we as the owners of it, we didn't get to enjoy those positive expected returns, but they eventually manifested themselves, but we had too much risk. We got the sizing wrong. And conversely, you can choose really bad investments, but if you get the sizing right, if you assess the risk correctly and think about your own risk preferences and so on, you're going to lose money by choosing the wrong investments, but it's not going to be so catastrophic. So I think that getting sizing right is kind of more important. And I think that it's easier too, in some ways. It's certainly, I think, easier than trying to beat the market. So we saw this big gap where it just doesn't get discussed that much, that, of course, academics and so on have talked about it a lot and so on, but I'm saying, like, in accessible books on personal finance, in the media and so on, the sizing question gets much less attention than the what question. What should I buy? The selection question. So we thought, let's write a book and fill in this space with some ideas that we're going to take these ideas. There's nothing too original in the book. We're going to take these ideas, which sometimes are expressed in a somewhat more complicated way in academic papers and so on, and let's bring that and make it accessible to people. So that's sort of the background of the book. Why what it's about and why we did it. And I've talked about investing here, the investing sizing decision, but the complement of investing is spending, and spending policy is also like a risk decision. Like if you have to have a spending policy that is in sync with your investing policy. Otherwise, that also can lead to problems. And so we also go into spending. We get into a multi-period context with things as well. So we go, more, but I think overall, it's all about how much decisions, how much to invest in things, how much risk to take, how much to spend, how much taxes to pay, how much realizations to realize.
Yeah, no, those are it's funny. People many times it always comes down to sizing, right? When you have a winning position, it's like, oh, I never had enough. When it was a losing position, be like, oh, I had too much. You never get it right? It's hard to like LTCM, which I thought was an interesting case study in many levels. And the way I kind of read into it was like, well, too much leverage. And in part, from what I understand, Wall Street likes to take down the big dog, right? Like if we can see something, we can poke it, we can sweep the leg, and pull the leg out and make lots of money doing it. We're going to do it. I mean, I've seen a bunch of cases like this in Wall Street where, you get some well-known models and people just know what's going on. We're like, all right, well, we could take advantage of this and we can make a piece of that. And then you get a little black swan thrown in there, and everything falls down. But to me, that seems to happen a lot, where smart people get I hate to use the word undermined, but undermined by Wall Street's capitalistic nature sometimes. So
yeah, possibly. I mean, I think that we had a lot of company, in terms of that, early period of losses. I think, that part of the problem was that these investments that we had were just too crowded. So yeah, but yeah, there's definitely, I think you're right though, at some point things kind of became pretty obvious that there were good profit opportunities, to make bets against, what was going to happen. Yeah.
So I do want to touch on the topic, the puzzle of the missing billionaires,
Yeah,
because
so right,
go ahead.
I didn't really get into the title of the book, which is The Missing Billionaires: A Guide to Better Financial Decisions. And the book is not about these missing billionaires, but it's a great jumping off point, and it was really instructive to me and my co-author James, as we just thought about whether there really was a need for this book or not, I guess. And there were a number of experiences that we had in our lives that made us think that addressing this how much question was really important and would be valuable to people. But the missing billionaires is sort of this idea. Actually, I first presented it in a TEDx talk about 8 or 9 years ago. And it's basically the puzzle of the missing billionaires in America is basically this. I mean, there's different ways to express it, but here's a good, simple way. Back in 1900, census information suggests that there were about 1,000 families that had more than $5 million of assets. If each of those families had been able to earn a return that was similar, close to the U.S. stock market compound return since then till now, and if they spent 2% of their wealth each year, and also paid tax on that 2%, so it's almost like they're spending 3%, let's say, between taxes and actual spending. And if they had children, sort of at a normal rate, then each one of those 1,000 families should have descendants today, household descendants today, each that would have more than $1 billion of capital. And that's assuming that nobody made any more money from there, and that assumes that nobody else kind of came along 10 years later and joined the ranks of those wealthy Americans at that time. Well, just an inspection of the Forbes billionaire list, when you look at the Forbes billionaire list that they publish every year, it's really hard to find anybody on that list who you could say draws their wealth from that, from a family ancestor in 1900. And when you look at, and when you read about a lot of other families, in particular, like if you look at the Vanderbilts, that Cornelius Vanderbilt passed away in, 1870 something with $100 million. By 1950, there were no Vanderbilts that were even millionaires, let alone on their way to being billionaires. I just read a great book by a woman named Janie Scott, who talks about her family that where her on the mother's side and on the father's side, they came from great wealth in the Philadelphia and New England, railroads and stock brokerages and so on. And they had a 600-acre estate on the main line in Philadelphia. And sort of the same thing, by, I don't know, 1950 or 1960, they were no longer, in that same strata of wealth in America. So what caused this? Well, let's think about what might have caused it and see if we can eliminate some things. So, well, the first thing is like, maybe it wasn't a very good investment environment. Well, we could put that aside. It was, this last 120 years was an incredible investment environment. U.S. stocks took, compounded $1 into $100,000. And, these families, there were lots, that these families didn't need to exactly even match a lot of these families wouldn't have needed to match the US stock market return. They could have done worse. There's other approaches, they could have done some dynamic asset allocation and gotten the same sort of returns. So the investment environment, that's not a good explanation. Is it kids? Is it that they just had so many kids? Well, no, we sort of calculated that some families would have more kids, other families would have less kids. In many cases, these families back then would pass the money, even if they had lots of kids, they would pass the money down to the eldest son or the eldest child or the eldest couple of children. They wouldn't split the money up evenly. And then there was also assortative marriages, right? Where, two wealthy families, their kids would get married, and that would really, that should help us to see more, wealth preservation over time. Is it spending? Well, again, we built spending in at 2% a year. That seems like a pretty decent, amount of spending for them. We took taxes into account. Was it charity? Well, that was an interesting one. We did some looks into how much do the very wealthiest people give in charity. And on average, recently people have been giving, people in that top wealth level have been giving something like 0.5% of their wealth away per year, with some people giving more and some people giving less. So again, I don't think that's the explanation. So what are the explanations? I think that, I think that's a really good puzzle. So what is it? Was it fees? Maybe it was fees, that these guys were getting charged really high fees by investment managers. Again, it's possible that affected some, but many of these families weren't paying fees at all because it was just family businesses. The Vanderbilts, they owned railroads and shipping. It wasn't like they owned stocks and were paying a mutual fund manager or whatever to manage those portfolios for them. And also, it should have been easier back then for active managers to deliver value for their fees, just given the information rules, the sort of the relatively unenforced or legal nature of insider trading and their rules. So what do we think that it was? And now that I've eliminated all of these things, well, what we think that it was is sort of two things that are a little bit subtle. One of them is we think people were taking the wrong amount of risk. So that we're not saying that the return that they were getting was bad. We're saying the risk was either too much or too little, and that caused problems, and that their spending policies weren't appropriately matched with their investment policies, that they either spent too much and or had spending policies that were too inflexible, that as their wealth fluctuated and as expected returns fluctuated, they didn't modify their spending to keep it in sync with that. Well, what do we mean by the risk being too much? Well, I think we have to bring in this concept of volatility drag for that. This idea, right, that if you have $100 and you make 50% on it and then lose 50%, your average return was zero, right? Plus 50 average together with minus 50 is zero, but you went up to 150 and then down to 75, you lost 25% of your money. And of course, it works the other way too. If you lose 50% first and then make 50% on that, you also wind up at 75 and down 25. Well, the markets aren't exactly binary like that, but we could do this thought experiment. Like, imagine that you had a crystal ball, and you knew that, like, over the next 100 years, for sure, the average annual return of your investments would be 5% more than the risk-free rate, for sure. So there's no risk in terms of what the average is going to be. But you've got a pretty volatile portfolio of assets. It's got 30% volatility. Now, how much of that would you like to invest? Well, let's just keep it simple and say that this is your investment portfolio, right? Well, the volatility drag that you're getting there is enormous from that 30% annual volatility, because let's say, you could think of that as being like, well, I make 35 when I make money and I lose 25 when I lose money. So that gives me an average of a 5% return each year on average. But if I make 35% and then lose 25% on that, I basically am back to zero. Like I'm basically 1% higher than I started. So my compound return is only 0.5% a year. So my average annual return is 5%, but my compound return is 0.5%. So you can see how, that by having too much risk, these these wealthy families really put a significant dent into their compound return. That when risk gets to be too heavy, it's really eating return. The risk is eating the compound return. And by the way, if you thought, oh well, gosh, if I know for sure that the average return is going to be 5% a year, maybe I should leverage a little bit. Well, then you're going to lose like all your money, because now you've got, let's say that you just leverage 50%. So you buy an extra $50 worth of this portfolio, and you're borrowing at the risk-free rate. You're not even borrowing at some high margin rate. Well, just that leverage and that increase in the riskiness of your portfolio is just going to drive that central case compound return of your portfolio very negative, and drive your wealth down to zero over 100 years by taking too much risk. So this risk is really eating return, in the central cases that we have. I think that, what did these families probably do? I mean, they probably didn't have a really well diversified portfolio of stocks, that they had one or two or three or four different holdings of different things, family businesses, things they liked, things they understood, things they were close to. And it's really quite conceivable that these guys ran 30% annual risk instead of the 15 to 20% of the stock market. And this variance drag really, took their value of their assets down over time, for most people and on average. And then, just combining that with a bad spending policy. So if your compound return is only going to be 0.5% a year, obviously, if you go out and try to spend your expected return of 5%, you're going to wind up with no capital pretty quickly. And if you do it in a fixed way, it's even worse. Like if you just say, okay, I've got $10 million, I'm going to spend 500,000 a year adjusted for inflation, you'll run into the ground really quickly. But even if you just say, I'm going to spend 5% of my wealth every year, which is the expected annual excess return, because of that volatility drag, you're going to, again, in that central case, you're headed down to zero in a hurry, and even faster because you're paying out this large amount of money. So I think that, to the best of our guess, we think, it's a little bit subtle, but we think that's what happened. Too much risk and badly matched spending policies to the portfolios that they had. And of course, returns were higher than 5% above the risk-free rate for US equities. I was just using that to make the point. But, that extra volatility drag and those bad spending policies, were enough to take 3% off of their returns. And if you take 3 or 4% off of their returns, they can't turn their 16 descendant families into billionaires. That doesn't work anymore. And it doesn't work for any of them. So that's kind of that's the puzzle in our tentative answer. We go into a lot more stuff in the book about it, but I think just for a brief description, that's how we see it.
Nice. That's interesting. Yeah, I always wonder about things like that. If you're a billionaire, is it missing, or are they smart enough to hide it? Now, I don't mean from the government, but from the public, right? If you think about this generational wealth, and it doesn't apply to every family, but, if I'm worth $1 billion, A, I'm not going to tell anybody about it. And B, I'm going to find ways to hide it so that people don't target you as being uber wealthy. Now, there are plenty of people who want that. They want to live the lavish lifestyle, and they want to be important, and they want to do all this. But, there's wealth creators, and then there's people who just happen to get wealthy. And
yeah.
I know a lot of the family offices.
Whether there are a lot of, these missing billionaires that aren't missing, but they're hiding or whatever, it's not really, the math that we're sort of talking about, and the math of the decision making, and what is volatility drag, and what are sensible spending policies, like that just makes sense, no matter what they do. Maybe these guys did a great, maybe there's a bunch of families out there that are sort of under the radar, and great, that the books, the book is just using that as a jumping off point to just think about it, to think about what those explanations, and again, that they're real, that if people were doing a good job, we'd have tens of thousands of these. Like, I think that sure, we're going to find, like, if we really could look everywhere, we'd turn up a bunch, but not tens of thousands of them.
Agreed. Yeah, no, I mean, your point's well taken. I mean, the math
Yeah.
is the math. And honestly, knowing human nature for what it is, I can't guarantee you that they're all gone, but it's just knowing human nature. Most likely what you're saying is 100% correct, because people just, first generation makes it. Second generation's usually a little tougher because the first generation kind of honed their I guess their financial acuity, and then by the third generation they spend it all and it's all gone. Like, that is, what do they call it, shirt sleeves to short sleeves to shirt sleeves in like 3 generations. I mean, it's very common. So I'm not surprised, although the next generations now, like what's going on now with the family office concepts, huge concept of just, basically not allowing them to make those stupid decisions, but keep it in house so it's being managed so it can perpetuate. But who knows? It's a constant challenge, I guess. Hey, if you're a wealth creator, you're not going to care because you're dead. But I think it's an important concept to understand how human nature plays into finance, and some of the things you talked about here in the show, and certainly in your book, are how people can be smarter investors. So, and I think that's why we do this show, is to help educate people.
We don't, I'm not sure that from a societal point of view, having more billionaires is good or whatever, but it's just really interesting. It's like this window, right? It's like this window into, is there a problem here? Is there a problem here that people can be helped with? And I just think that window, helps. I mean, and there's other windows, it's not the only window. It's not the only piece of evidence that's making us think that the sizing issues are important.
Yeah, totally. Well, I like studying these things because it's very public. So you get to see the good examples and the bad examples. And it just shows the rest of us like, oh, well, maybe we should think about this too. If you're worth $1 billion, you've got money to spend on high-priced, people to help you do the planning. But for most people, they don't have that. So you can learn from these people and implement it yourself. So, Victor, I really appreciate you coming on the show again. I always enjoy our conversations. Where can people find more about you?
The Elm Wealth website, elmwealth.com. And our book is on Amazon. We hope people enjoy it. If you like it, write a review. If you don't like it, send it to somebody you don't like. That's where the book is, Elm Wealth. We have a bunch of research there, and all kinds of goodies, some experimental games to play with coin flipping and so on as well. And feel free to send a message, if anything's of interest.
Awesome. Well, Victor, once again, appreciate you coming on the show, and we'll probably have you back in the future once again.
Thanks, Kirk. Appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show, and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Victor. Really appreciate him coming to the show. I know he's been on the show before, but always enjoy our conversations. Now we're into the panel portion of the show where we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, and it's just me today.
Just Megan. We don't need anyone else. Megan is all we need for this one. So
pressure is on.
Yeah.
It's good that I really liked this interview. He was an interesting guest. Really reflective, thoughtful, smart. It was just interesting. And I think his book, I want to read his book because he touches on a lot of stuff that we don't talk about enough about. I mean, he says it at one point in the interview. He said, look, I'm not saying anything that people don't know about, but I'm talking about it. And that's important.
Yeah, no, I think it's really, I really appreciate the fact that he's willing to talk about like long-term capital management. I mean, that was a big mess. And I think we all make mistakes in our careers and our lives. And so somebody who can be humble about it and come back and learn from it. And I think it's great, because it wasn't his mess, like it was many people involved, but it was being a part of it. I think you think about the people in Lehman Brothers and Bear Stearns and like, what are they doing now? Well, some people just disappear into the background, just decide like, I don't want to do this again. And other people like, you know what, I still enjoy this and I'm going to pick myself back up and go out there. We all make mistakes every day. And so I appreciate the people who can come back and be like, just authentic about it and share, because we all learn from that. And the reality is there's plenty of bodies on the side of the road of Wall Street in history. And, you learn from that, right? Like we all are better investors because somebody else went there first.
I think that's a great point, right? Like we always talk about the winners, right? Because the winners are more fun, but it's the bad experiences and it's tough. Like, so can I ask, what is your worst investing experience? Obviously it's not what he went through, but do you have any bad ones?
I've got plenty. I got to think of a good one. I'll bring up a good one because this is I've definitely had some over the years. I tend to take a little bit more risk than I do for my clients. I'll invest in like gold mining stocks and things like that for like as a speculation, not all my money, but just, a speculative part. And I do stuff that has maybe higher risk that I don't put clients in because it's maybe not appropriate for them. But one thing I did a few years ago, and I'll share it because I think it's instructive. There was a Chinese company that I had a friend who was doing research on it. He was an analyst, and he went over to China, met the people, saw the company, all the assets, like real company, right? You hear about these companies that don't exist, and that happened like 10 years ago. There were companies that just didn't exist. This company exists, had employees working, all of it. Everything was great. All the numbers looked great. And then it came out with some short seller came out with a report and like, oh, this company's worthless. And, you never know if those are true because they're trying to bait the market. And so I was looking at him like, yeah, this sounds to be a little bit fake. Like my friend was there. He saw all this stuff. And then it came out that all of that was valid, except for one thing. The owner of this coal company had rehypothecated the shares of the company to a private equity firm and didn't tell anybody. So technically, the assets were worthless. Even though the company was there, the shares that are publicly traded on U.S. exchanges were technically worthless because this guy took the shares and rehypothecated them to a private equity firm, didn't tell anybody. So technically, the shares weren't backed by anything. So it's something that small that you couldn't figure out because no, it wasn't disclosed,
right?
Yeah.
It's not like it was disclosed, nobody saw it. It wasn't disclosed. You couldn't have found this. And the only reason it came out is, I don't know how this guy found out, but the point being is that there's risk everywhere in the market, and you have to be really careful. So even if you do all your homework, there are plenty of opportunities that you could implode or lose money. And this is why it's so important for risk management first, is that you can never put all of your, Warren Buffett always talks about, he's like, put all your eggs in one basket and watch that basket, right? And his theme is like, I don't need to invest in 100 companies. I can invest in like 10, and I know those 10 inside and out. Well, that's great if you're Warren Buffett. I'm not, and I don't try to be. So I think about it a little differently, of like, if you're taking a risk and I'll give you a perfect example. This is a risk that I think anybody can identify with. Let's say cryptocurrency, right? Let's take Bitcoin because it's, the premier one. But let's say Bitcoin, okay? Take that as a risk to reward trade-off. If I put money into Bitcoin or any other, I think call them shit coins, any other coins that are, you could argue they're worth, but let's use Bitcoin because I think it's more stable. So let's say put a money in Bitcoin. Now the thesis is it could go to zero. I could think of multiple reasons it could go to zero. I know the Bitcoin enthusiasts don't agree, but let's just assume it could go to zero, because it can, just like anything. Or it could go up 20x, right? Let's say that's the parameters. Now, somewhere in there is the truth. It could be zero, it could be 20x, or it could be somewhere in the middle, right? Now, the hope is that it's on the upper side of that, but you have to acknowledge that it could go to zero. So if you acknowledge that it could go to zero, and let's say the odds are 50-50 of doing one of those two outcomes, nowhere in the middle. Let's make it simple for the listeners. It could go to zero, it could go up 20x. Let's say the odds are 50-50. I'd take that bet any day of the week, because of the way the odds are structured. You flip a coin, you win $2. You flip a coin, you lose $1. Those are great odds. I'd do that, right? That makes sense probability wise. People don't generally think this way, but that's the truth of it, right? It's not just about risk and reward. It's also probability of risk and reward. And so if you look at an investment and you say, all right, this could go to zero. Mm-hmm. Am I going to put 100% of my wealth into that? Absolutely not. That would be stupid, even if it's going to make 20x. Now, if your wealth is $10,000 and you're a college student, okay, maybe you could make that argument. Maybe you could do that. I wouldn't do it, but okay, I can make that argument that maybe that would make sense for somebody who could very easily make another 10,000 next year, and they're a college student. They don't need the money, right? So that's different. But if you're like 65 years old and you have $1 million net worth and you're going to retire next year, that'd be really dumb to put all your money in Bitcoin. So I think we get caught in easy money scenarios, and people don't think through the risk that they're taking, and they don't understand that, I didn't put all my money in this company. I put maybe like 3 or 5% or whatever it was. That was it. So if you lose 3 or 5%, I mean, nowadays that's like a day or two of stock volatility in the S&P 500. But right. It's an acknowledgement of this could happen, and what am I going to do if the worst case happens? And I think that's how you have to look at it. And what I learned from it was I don't invest in individual Chinese stocks anymore, because I can't trust the regulatory environment around that. And so if I was to invest, I'd probably invest in like an ETF, which if there's a single stock that's screwed up, okay. But is the whole system going to be? Probably not. It could be. I could come up with a scenario where it could be, but probably not. So you have to think through, like, what is this going to mean for my portfolio if things go horribly wrong? The Russian ETF, a perfect example, that froze after the war started. They froze it. They stopped trading the I think it's RSX or something like that. But the Russian ETF, it stopped traded. Could it start in the future? Maybe. I actually put in, a few $100 right before it closed, because I was like, well, if it opens, it's going to skyrocket. If it doesn't, it's a few $100. But the point being is, I knew I would probably lose that money, but it would turn out like probably 5 or 10x, and it still could, right? But that's the calculus that I made with it, knowing that it could go to zero. And I think you have to look at every investment that way, with a lens of realism and not just pie in the sky. Oh, it's going to go up 20x. Don't worry about the downside. You have to look at both.
I think that touches on what Victor said. He said something in the interview that struck me. He said, we spend so much time focusing on the what we invest in and not the size of the investment. And I think that's incredibly important. And as a little bit of backstory, I've worked with corporate executives. So for my whole career, I've had to deal with people who have to take the risk of owning a concentrated stock position, right? And what I would say is, diversification preserves wealth over the long term. Great wealth is created by starting a company, right? Having a large concentrated stock, taking risk, right? So, I think what you have to do is you think about your portfolio is sizing matters. And where you're trying to have a reasonable rate of return, that's where you should factor in sizing. But if you're someone at a company, right, and you are getting opportunities to buy stock, whether it's through ESPP or you get restricted stock or stock options or performance awards or whatever that is, you have to develop a philosophy. And why I say this is when you are in these companies and you're an executive and you're forced to have a very large position in the company, you sort of have to decide, okay, how am I going to manage my risk? Is it, I'm just going to let this ride, right? And accept the fact that it could all go to zero? Or at the right moments, do I want to choose to take something off the table? And I always say to clients, look, I hope when you sell, this is the lowest price you ever sell at, because everybody Monday morning quarterbacks if they watch the stock price go up. But it's really important at key moments when you take on incredible risk to pull something off the table and sort of move it into the diversified, manageable sizes where it's return at a reasonable rate. And those are the things that I think it's easy to say, it's incredibly hard to do, particularly when you're holding a concentrated position and everyone else around you is as well. And everybody talks constantly about where the stock is, where it's going, and so on and so on. And you don't want to be that guy or gal who sold too early. But you also don't want to be that guy or gal who sold too late.
Yeah, I think I saw a quote this week from, I think it was Seth Claren, and he was talking about lessons learned from 2008. And I may have misattributed the quote, so apologies if I am. But it was, I would rather sell too early than sell too late. And I think it's instructive because, one of the challenges, if you think about investing, is when do you get in, when do you get out? Those are two transactions that you have to assess very well. Now, if you're buying
you only get one of those right, and when they've studied it, right?
Right. And it's hard to get them both right. It's hard to get even one right, right? Because you're never going to pick the top, you're never going to pick the bottom. It's just not going to happen. And you have to get through that through your head. Is that you might get lucky and you say, oh, I can pick tops and bottoms. I mean, personally, I've been very fortunate. There have been times I'm better at picking bottoms than picking tops. Tops are not as easy, but bottoms, there's a certain point where you're just like, you know what? This is good enough. It's just like, this is so cheap. I don't care if it goes down anymore because it's still dirt cheap. I mean, look at crypto last year. It's like at the end of the year, it's like, wow, it's pretty ugly and it keeps going down. But you know what? This is cheap enough. And you just put in some positions and it turned around because the end of the year tax loss selling and other things. But the point being is like, there gets to be a point where, and this is where value investing comes in. Value investing is about fundamentals. It's about pricing. Growth, not so much. I mean, you could argue, oh, well, no, it's still about the numbers. It's really not. It's about momentum. So the momentum is the momentum going to continue? You could say, well, the PE is up at 35. Yes, but is the PE going to be 55 at a later date? Is the earnings growth going to continue at this stage? And people, they have different metrics. So yes, it's still based on fundamentals somewhat, but most people invest in growth stocks for the momentum. They don't invest based on the fundamentals. And frankly, they don't need to. Since 2008, who's been paying attention to fundamentals? I mean, it's crazy in what's gone on. And so when you got, Amazon at, I forget what it was, like 200 PE or something like that. Now their accounting is different, so it actually doesn't reflect reality. And I just want to point that out because some companies
are not reflective of reality when it comes to, let's say, a normal calculus of how you'd analyze a stock. It's kind of like, all right, if you run it this way, actually, it's a highly profitable company. But if you dump all the profit back in CapEx, it doesn't look like it's profitable. So there are some things you really have to be good at the numbers to understand. But generally speaking, value investing has been out of favor for 20 years, and maybe even longer. I think what that should tell you is that value investing isn't dead. It's just out of favor. And it's mostly out of favor because of what's going on in the world. It's easy to invest when rates are dropping and they're printing money and all that. Everything goes up. Why would I invest in a value stock when I can invest in, like, big tech number 2, and everyone else is going to invest it and it's just going to keep going up because it's going up? Like, that's not really investing, that's speculation. But not to say you can't do it. People have made lots of money doing it, right? It's like crypto. People have been putting in crypto. You could argue whether it's a Ponzi scheme or not, but it's basically like you invest money and somebody else wants to pay you more, so it's going to go up, and then someone else is going to pay you more. It's just, is it worth anything? Not really, but neither is gold. But gold has intrinsic value, right? And crypto doesn't in itself. So,
I don't know. Crypto has never been regulated, so that's part of the problem as well.
You know what? You and I can debate on this, Megan, because I don't agree that regulation is a reason for investment being good or bad. I think investment is what it is. If I invest in farm equipment,
protect people who can't properly assess the risk coming at them. You're in a different group, right? You understand risk and what happens. I think that there's a lot of people that fed into the crypto craze that didn't fully understand it really could go south and go south fast.
But regulations, that's not what the point of regulations are. Regulations are supposed to protect investors in publicly traded stocks, but they don't, because the regulator's job is not to police. They're the cleanup crew. They're not the police. We think they're the police, but they're really not. They're the cleanup crew. So if you look at like Bear Stearns, Lehman Brothers, you look at AIG, you look at all these companies that have basically, imploded. Why? Well, it wasn't because they weren't regulated. They were regulated. WorldCom, Enron, like, they were regulated. It's not the regulations. They might make it a cleaner market. They might make it easier to find information, but the regulations aren't what make it good. The point I was making about crypto is there's no intrinsic value in of itself, right? It's gold. You're wearing gold. I have a gold ring, like, wrong hand, wearing a gold, like, we wear gold. Gold has intrinsic value in our society and our culture, and as a people, it always has in human history for long periods of time. That is intrinsic value. So is oil have intrinsic value? Yes, we use it, right? So our crypto doesn't have intrinsic value, or not all crypto, like, say Bitcoin, because Ethereum is used for other things. But the point is like, if there's no other use, it's like, what's it valued? What's valued what somebody's willing to pay for it. And so people trade all sorts of things. They trade domain names, they trade tractor equipment, all sorts of stuff. And I think you have to assess valuation based on what its worth is to other people, right? Gold is worth something to other people. Tractor equipment is worth something to other people, right? And is crypto? Yes, it is, because other people wanted to pay you for it. But the government said, we're going to tax you 100% on the value of your crypto. It'd be worthless overnight. Would people still use it? Probably, but it's not going to be worth what it is today. So are there things that can be done that can change value? Sure. So I don't know. I think regulations, I think it's I mean, you probably have a different opinion, but I think it's maybe a red herring a little bit. It brings value, but it's not the reason that it brings value, in my opinion.
You couldn't get me to invest in crypto at all. I just did not feel like it was regulated, that it was protected. It was just, it felt like the Wild West a little too much. So
still is.
That's okay. That's, it's funny. With client portfolios, some clients want to be in it and we don't advise on it. We let them do what they want to do. And as a tax attorney, I'm always looking for losses. So it worked out. But I think, going back to the interview, I want to touch on the fact, a couple things here as we come into year end, to just sort of remind people of as they look at their portfolios, right? Because it's been a really, really rough ride. in the markets in general. And then for those who have sort of a concentration, right, it's even harder, right? So, I mean, I think in general, you really need to be looking at your asset allocation percentages to make sure you have the right amount in the portfolio in certain asset classes. But as we come into year end, you know, for anyone who has a single stock position that still has appreciation in it and they want to diversify away, but they don't want to sell, one thing that they should consider is potentially gifting, right? So I have a lot of clients that gift their single stock positions to their children, right, as a way of passing wealth, doing, you know, generational wealth transfer, but doing it in a way where they're sort of mitigating their concentration risk. And when you gift someone stock, like, so Kirk, if I gifted you, you know, the annual gift exclusion this year is 17,000. If I gifted you 17,000 of a single stock position, you take my holding period, which can be a great thing, but you also take my basis, right? So that is one of the things to keep in mind. The other thing, you have a single stock position, is I have a lot of people that have owned a stock forever and they've got a lot of low basis stock. So we do a lot of what we call upstream gifting now. And what that means is, like, so I have a client who owns a stock that has a $4 basis. The stock is trading closer to $2.50 today. We have gifted it to his parents. We have gifted some of the positions using the annual gift exclusion. We hold it in the parent's name in an account that is TOD, transfer on death. And here in California, you get a full step up in basis at death. And so what's going on is we're waiting for the parent to die. It's very morbid, but actually all the parents are really they're all into it because they like the tax idea. And they get the full step up in basis, and the asset transfers back down to the child with the step up in basis. So these are a couple of ideas out there if you're sitting there with a large diversified position. And then obviously the last idea is you could donate stock to charity. And they will take the stock and you don't have to recognize the capital gain. So when you have these concentrated positions, there are a lot of tools out there, and particularly here at year end, very valuable to take advantage of.
Yeah, it's a great point. I think it's funny because since 2008, a lot of fund managers and a lot of individuals have just said it's not worth single stock risk. And a lot of funds have ETFs in them now, like mutual funds. They use like the SPY and a few other mutual funds, and they use a bunch of ETFs. And it's kind of like, well, what's the point of having a mutual fund if you have an ETF in it? But what they realize is that it's so much harder to beat the index with single stock risk. And I remember in 2008, like looking at value managers, and they were all buying Countrywide and WAMU, and if they were buying all those companies, end up going to zero. And they're like, oh, they're great value. Like, yeah, okay. Good luck with that. And, you know, I didn't, like, nobody really knew the depth of the problem, but I knew it was risky. And from what I was hearing, like, there's no way I'd touch that. And these people are like, oh, it's a great value. And I think that the challenge is that, you know, value managers are buying things at a discount with information that they know. And of course, you don't always know all the information. I mean, Warren Buffett owned Wells Fargo for a long period of time, and there were tons of problems, let's just say, at Wells Fargo, and they you know, he ended up dislodging his position at some point. And so I think, you know, it's really hard with single stock risk. You have to really be on top of it, and in this day and age, fewer and fewer people are doing it, which is good and bad. I mean, if you own a huge position in a big tech stock that you own from like 20 years ago, you're probably pretty happy. But in the same point, like, at what, and this is something maybe, Megan, you can get your insight here, but you know, if somebody owns a stock and the cost base is virtually zero, like it's pennies a share because you've owned it so long, like a big tech, let's say, and let's say you decide, like, hey, the market's really overpriced and I think it's going to drop a lot. Like, that's our thesis. We think that the market's way overvalued and it's a good time to have cash or liquidity. But the problem is, if you have a big position like that, you can't, like, you're going to sell it. Well, maybe you should sell. Like, it's the question, like, do you sell it?
Don't let the tail wag the dog. Like, don't let tax, like, at a certain point in time, if you made money, it's unfortunate if you have to pay taxes, but don't sit there and ride the position down. And, and Kirk, we've talked about this on other shows, there are some things you can do, right? So you could look to offset any gains with losses in the portfolio. I also love year end, right? Because you can do something on December 31st, and then you can do something on January 1st, and it's 2 separate tax years. So I think it's more about having strategies to get out of the position. And then, it's also, keep in mind, I work with a lot of clients who are executives who are working, so they can't sell. But for my retirees, a lot of times we do take advantage of something called an exchange fund. And what that is it's sort of like a swap. You go in and you invest, you move your single stock position and you pool shares, and it allows the investor to exchange their holding of like single stock for units of the whole entire portfolio. And so it takes time to diversify away, but it happens over the long term, and clients find that an effective method of diversifying. The other thing I often find is we like, once clients retire, to do covered call positions, right? Sell the call on the stock, take the premium in, and then wait and see if the stock gets called away. I've had clients do incredibly well with those strategies, and it makes a difference. But if you're sitting there and you've got, you feel the stock has the stock has run, it's not got much more upside, and you're sitting on low basis, just make sure you earmark money for taxes. Don't get burned. But it's not always a bad thing to take it off the table and recognize the capital gain.
Yeah, it's interesting. It's some great thoughts there, Megan. I kind of think about it, the exchange fund. So maybe we should have an episode on exchange funds, because it's something that you hear very little about. I remember when I started in the industry, there were like 2 exchange funds. I think it was like Eaton Vance, and I think the other one was, I forget the other one, it was Fidelity or something.
Big one. Goldman has one.
There's a lot more now. Like 20
Yeah.
years ago, there were like 2, and it was just a weird thing. But maybe we'll have an episode on that if we can find somebody runs one of those funds to talk about it. But yeah, so I mean, there's definitely some strategies, but I think the hard part is you're in some ways, let's say you do a collar. So like we do this sometimes for clients, we'll like collar a position. If we think it's way too expensive, we'll just, collar it up. But the problem is you're just like, all right, you're protecting the position, but then you're basically, let's say it goes down, right? You call it right, and it goes down, you make money on the collar. Well, now it's short term, right? So you're paying short term as opposed to long term, which is more preferential. So it's just a question, right? It's hard to dislodge when you realize you're like, all right, I've got a huge position, now I got to sell some or all of it and pay all this taxes. Nobody wants to pay the taxes, even though it may be the best thing for you. So and then there's always the question of like, then you sell it. It's like, oh, I wish I didn't sell it. You never get it right. Like I've had some people, like, we usually, when we have these positions, we talk through people like, all right, there's 3 different scenarios. Let's talk through them. Like, you sell it all as one scenario, and here's the pro and the con. The pro is, hey, maybe you top ticket and you get lucky, right? And probably not. But what's probably going to happen is it's going to go up more, and you're going to be disappointed you sold it so low. But you got a bird in the hand, you get your cash, be happy, move on. Another thing is you don't sell it and it goes down, and you're like, oh, I wish I sold it, right? So you're never going to be happy. Like, there's no outcome where you're like, unless you top ticked the market, which is almost impossible to do, you're never going to be happy with the outcome, right? And this is what I tell people, like, you're not going to be happy. Just accept whatever the solution is and move on. Because if you start thinking about it, you're going to be disappointed no matter what. I paid too much taxes. I missed out on this. I didn't do this. There's always going to be something. And so you just have to put a plan in place and move on. And I think that's the hard part. Like, then the third scenario is like, you do a little bit of both, right? You put in a plan, sell some here, some here, some here. But ultimately you're never going to pick the right price. It's just impossible. And I think that's the hard thing for people to get over, is like, oh, I had all my wealth in this thing and it kept going up and I missed out, or, whatever. So I don't know what your experience is, but I see that all the time. And it's such a hard conversation for people because they get it intellectually, but they don't get it emotionally.
Right. It's tough. I mean, so much of this is emotional. And I got to say right now in this market, it's very, very hard market emotionally. I find people, really just struggling with what to do next. And I don't think they're served well by articles like in the journal today when we're taping this. There's an article on like the 60/40s, that strategy's done, right? And it's frustrating to see that because it takes away from the fact that investing is a long game, right? And that you can't make decisions on just 2 bad years. You have to sort of think about it in context of everything else. And right now the markets are shifting because of what's going on with interest rates. This will be a very telling, Fed meeting in the next week or two. So.
Nice. Well, we're going to wrap it up here in the interest of time. So, Megan, final thoughts from you.
Yeah, I mean, I think take what he said about focus on the size, not always what you're invested in, as really good advice. It's thoughtful advice. It's the advice of someone who's been through a lot, who's had concentrated positions. And keep in mind, if you are going to take the risk in being in a concentrated position, you have a bundle of decisions that you can go through. You can hold it and accept the risk. You can diversify over time. You can exchange into an exchange fund. You can sell calls. You can donate to charity. You can gift to your children. You can upstream gift to get, a step up in basis. There's a lot of decision making that goes around that. So you need to make sure you're thinking through all the decisions. And always remember, if you sell because you think it's at an all-time high, so you pay tax. It's not a great tragedy. Paying tax means you've made money. That is a good thing in a way. So don't let the tax, tail wag the dog, right? So I'm Megan Gorman. You can find me on Instagram at All the President's Money. Kirk, thanks for having me on.
Thanks for coming on, Megan. And that's I think this is a great episode with Victor. I really appreciate him coming to the show again. We'll probably have him back on the future. We like having good guests that have a good perspective on things. So but yeah, as we get into the end of the year, obviously some of these tax strategies will come into play. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.